Hi, welcome. This is Ryan with the Paper Podcast. Thanks for joining me today. My guest today is Tanner Mayo. I'm sure you guys already know him. He's a president of FedFis, Bankers Helping Banks. He's part of the FinTech Cowboys. You know, he and his father by far my favorite banking podcast. You know, because just like they say, they cut through the bullshit, and there's not enough people in the banking community like them out there. So please listen in. I hope you enjoy. Hey, welcome Tanner to the Paper Podcast. Thanks for joining me today. You know, I've been watching yours and your father's videos and everything, and I love how you just cut straight through it and cut through the bullshit. And there's not as many people out there in the banking community to do that. Tell me a little bit about yourself, and
Yeah, man. So Tanner Mayo here, president of FedFis. A lot of people know us as FinTech Cowboys, me and the old man. And he's been around the business forever. I kind of joke with everybody. We're fifth generation ranchers and also fifth generation community banking. So, and if you've been around it long enough, right? There's a lot of that going around, a lot of family legacy and such. So, I spent most of my early days in my career on the technology side. So I was one of the early guys at Malachi. Later got acquired by Finastra. So if you think about the wild west of online banking, I kind of was in the second generation in the wild west of mobile banking. And I tell the joke that me and mobile kind of grew up together, which is fun. And then Dad's always been on the data side of the business. So for anybody that remembers Sheshanoff, he was the guy that got brought in from the company that's now books. He got brought into Sheshanoff from there to turn the old banking books into software. So if you put our brains together, whatever of a messy thing that might look like, that's what we do around here.
Oh, that's funny. Yeah, we used Sheshanoff for years, and I remember. I mean, I was demoing Malachi 6 years ago when we were out on the market looking, and I thought their product was badass back then. So
it was a wild time, man. So I got there. I think it was 2011. And I mean, it was very much the Wild West. We really, if you think about it, I think the App Store was like 08, 09. And so, I mean, a lot of people didn't have iPhones by 11 or 12, right? Or maybe had their first.
We didn't have online banking.
Yeah.
We didn't have online banking here in
See?
09.
Yeah. So if you think about it, what a lot of people thought at the time was that mobile was going to be online banking on the phone, right? And I think what we thought with the App Store specifically and natively having the device, the experience could be totally different. So, things like mobile deposit are a good example, right? If you're thinking online banking, you're probably only do, remote deposit from your computer if you're a business, there's no retail biz there. Same thing when we got into card management. So like turning your debit card on and off, we launched the first one of those at Citibank here in Texas. And if you think about it, we started seeing in the analytics, a lot of people would leave their card off all the time. And then as they're standing in line at a grocery store, they would flip it on. And then as they walked out the door, flip it back off. So the kind of a cool analogy for like the mobile experience is its own experience, right? Different from online. And so that was kind of the ethos, the founding ethos for the gang at Malachi.
That was the bank getting charged for every switch.
Yeah. Oh, no. So this is wild, man. It's kind of, they called it warm card at the time, right? As opposed to hot card. And what we did on the core system is set the limits at a penny so that everything would get rejected, right, at the processor. So it was kind of a fun and clever way to pull things off and make it no expense on the institution.
Yeah, that's cool. That product is extremely useful.
Yeah.
I mean, I just used it the other day. My, 16-year-old misplaced a credit card, But
I'll tell you, man, I've got a lot of focus on the card space for the last 4 or 5 years. About 5 years ago, there was a lot of people and a lot of the big management consulting firms telling bankers and telling vendors that payments was pretty much done, right? And I think a lot of us were screaming the other direction that, hey, never say never, maybe they're right, but it definitely had the feeling that there's a heck of a lot more to go. And I think if you look right now at just the economic situation, if I'm a community banker, cards and interchange is a wicked place to play. I mean, we see a ton of that in the
I'm constantly amazed that I would say majority and all the bankers that I've talked to don't even understand how much revenue they're making or not making when it comes to their debit cards. Are you seeing that?
Well, it's intentionally complicated. Oh, absolutely. So if you ever go through, and I've done, unfortunately, a number of these, really pick through a debit program at a community bank. And if you start factoring in all the cogs, so think about maybe it's not tier one support, maybe that's going over to a Visa or a MasterCard call center, but you still got staff answering and redirecting some of those phone calls, or it's lost cards that the institution's taking. So if you think about your staff time as well as back office operations and, all the parts and pieces that come into play, I think there's a lot more cogs in running a debit program than you actually see. And what you're looking at in your interchange check every month, right, doesn't necessarily reflect that very well.
No.
And then you factor in the cost of the program. I would tell you I'll bullshit my way through a number here, just throw a dart and say something like a $500 million bank. It's rare that I run into somebody below there without a heck of a card focus that's probably profitable when
I'm 100% positive we are profitable, but that was because I went through every single penny on prior core and moving forward and looked at every single aspect, because even my previous CFO, when we were looking on a core conversion, which included cards at that time too, and was like, all right, give me the reports. Give me the reports of income. I'm like, so we're making, I think at the time it was $6,000 a month or something. So I'm like, okay, that's good. But I'm like, it really doesn't seem right. It's because the expenses got billed separately. Right. And then I'm like, you didn't think to throw that in there?
Yes.
So the core would send your income in 1 week and then send the expenses another, and it was automatically negative. And then when I put in the chargebacks that we have to eat, because there's so many transactions, if it's under $25 or if it's a gas station or a hotel, or God forbid you allow, the rental car companies to use your debit cards, you're screwed. So when I looked into it, I'm like, yeah, you two think we're profitable. We're losing $15,000 a year on cards. And so now we've turned that loss of $15,000 to where now, including chargebacks, eating chargebacks, we're netting, and we're only 200 million in assets. We're netting $60K a year now in our interchange.
Yep.
But
well, I'll give you an interesting one. And I don't think this is fully baked yet. So this is just pie in the sky thought, but a trend that I'm seeing. If you look over the last handful of years at sort of the challenger fintech space, all the articles that you read, good or bad, are kind of ripping the chimes of the world apart for if the rest of us could run a profitable business off of nothing but interchange, we would, right? And it's a fair point. But if you break it down and you look behind the scenes with their sponsor banks and with the networks and the processors and how these agreements are set up, there's very little. A lot of them actually are passing on or taking a bigger bite out of things like chargebacks. So there's no fraud for them to worry about or liability on their paper, let's say. There's none of the cogs. Everything is tier one support going up to, let's say, a Visa DPS, right? You've got the custodial bank, which is typically also the sponsor, right? And so everything's sitting there. So all you're doing is the marketing. You're like a friggin' affiliate marketer, and they're building their own front end. Cool. And I wonder if we'll start to see banks, specifically community banks, thinking about card programs a little bit more that direction. Because, hey, if I could just guarantee, even if I'm getting screwed on my margin, but it's a profitable margin because there's no costs other than my marketing efforts to get my customers to use the card, that would, ballpark me, Ryan, 70-80% of the banks today under, let's just say community banks, that would be a positive. They'd be making more off that money.
But it sounds going crazy. Back to that, the average bank doesn't even know their cost per account. And, when I analyzed the core and everything at that time, 5-6 years ago, it was costing us, if I remember correctly, around $7.25 per month per consumer account. And that was because online
All
banking's
in. Yeah.
maybe $1.50, and that's not even, and that was prior to doing online onboarding and adding something like a Malazai type product that will add a few more dollars to the account origination. It's not even ongoing. And so when I looked at the average consumer, what they had in their account, and having to cut say $80 a month to just break even, and you're in a low rate environment, I'm like, there's nothing, I can't even break even on the consumer accounts. So why would I even offer these products that I'm going to lose my ass on day in and day off? So he said, we're either going to change or we're just not going to offer these accounts, because it was absurd. But I was continually amazed, and the majority of the bank CFOs and CEOs still didn't know the cost per account from their core when they threw in all those add-ins.
Well, and when you look at it, so we have a word that we use around here. We call it core
Yeah.
strategic. Basically, that means a bank that buys everything from the core. And I'll give you a wild friggin' stat, man. If you go back 6 years ago, that number was just almost 50-50. Okay. It was 48% that bought everything from the core. Today, that number is 82% that buy everything
Wow.
from the core. And if you kind of go back to, like I was saying, I grew up with mobile, right? I mean, there's a ton of products that are sitting on a core contract today that didn't exist when I showed up, 15 years ago, right? And I'm not exactly an old guy, I mean, you look back going to the, 2000 or into the 90s, think about pre-online banking, 90% of the products didn't exist. And so you think about the ease of the bundle, it makes so much sense. But all of the misinformation and rhetoric from the thought leaders, everything is APIs, everything is we want access to our data and open to third parties and best of breed. And the truth is, when the rubber actually hits the road, which in my mind is a contract, that's total bullshit. That's not what we're seeing. Doesn't mean that it shouldn't be easier and that that's not the right way and the more innovative way. So, disclaimer, right? I'm all for it, and I think best of breed third parties is you got to pick your battles. But I think picking the right fights and being focused in certain areas and not doing everything with the core is a good
Okay.
thing, right? But it doesn't mean that it's easier.
I'm constantly annoyed that, you know, I mean, have you met many banks that are happy with their cores? I mean, it just exactly.
Never.
So what annoys me is, bankers have contributed to this problem. So we're not happy with the average core, but yet they're too afraid to leave, and which is ridiculous. Like every bank needs to, have the willingness to leave their core at that contract, because that's the only way for the cores to get better at service, provide, be transparent on their contracts and be through there. Because, you know, a long time ago when I became CEO of Surety, you know, we didn't have online banking, we didn't have mobile. And as I was adding those on and added mobile with the core at the time, I get mobile and say, well, what about this option? Oh, well, that wasn't included. You showed me that during the damn demo. Or what do you mean it's not included? You alluded to the fact that it included in this bundle. How I know? Well, it's not in the contract. And so, they would pull that shit, left that core, and and again, the banks have to be not afraid to do core conversions. That's the only
You
way we're
bet.
going to
But
get them better.
there's something interesting. Yeah, you got it. I think something that I've seen interesting kind of on the other side of the world, the vendor side, and especially the emerging fintech guys, there's this theme, right? Of like the term legacy core, I think was like a friggin' invented construct by, I don't know, somebody who was trying to sell consulting
Yeah.
probably. But legacy cores, I'm like, where? And everybody talks about modern cores. And I'm like, I, for one, call bullshit. I'm looking at the data all day. I know who's signing what,
Yep.
who's converting to what, and there isn't anything. It's a nice story, man. And I've had a lot of them. I've worked with probably 4 or 5 in the last half a dozen years that are trying to build a core, right? Some of the names that we would all know. Some have had success and some haven't. But what you're really talking about, it's what we used to call headless core. So you're basically just talking the core system, not any of the surrounding ancillary products, right? So no account opening or onboarding, no online, no mobile, things like item processing or bill pay, e-statements, all that stuff. Let's put that separate and just talk core. My question is, how many banks really have a problem with just the core, and how much is actually the relationship, the service, and the surrounding ancillary products. And typically, that's where you run into your challenges, right? And so, what I've seen from some banks is kind of this, and this is a bit of a newer theme, but the thesis is screw the core. Let's basically relegate them to the background, make it the old dumb system of record that it should be, and let's focus on best of breed, either through them if they have great ancillary products, or through best of breed third parties, and just relegate the core into the background. But that is an impossible task if you've bundled everything onto one piece of paper, right? And so it's sort of odd, right? I advise it's situational. There's no one size fits all. But if I'm a very small community bank, I'm rural, I do a lot of ag, for example, maybe bundling everything up is the best path, right? That's not where you're trying to fight. If you're a little bit more, closer to a metropolitan area, maybe suburban, maybe you got higher net worth, maybe I'm focused on digital and I'm focused on wealth management, and I want to go out and get best of breed third parties in those areas, but buy everything else from the core, right? So I think ultimately, here's the kicker, man. I call it conversion pain. It is like the number one thing that every sales guy would get, right? I know if there's a competitor and I'm selling a product against them, I don't have to beat them 1 to 1. I have to beat them by at least 2 to 1 because of the cost change, right? And think about all the operational pain and everything. And so, what bankers are doing as they get deeper into these relationships, the more that you add to the bundle, the more that you're increasing your conversion pain. And I promise that the vendor knows that. So come renewal time, it's not going to be pretty because you may have looked at alternatives, but you haven't gone through the effort of scoping your own pain to change. And also things like conversion files and everything else that comes into play, right? So you may be 3 to 1 pissed off at them, but the pain to change is a 5 to 1, right? And it's not worth it. So I'll give you another good stat. There's about, rough numbers, man, but about 750 banks a year that do a core
Yeah.
review, right? So out there looking, and we see just almost on the nose 100 core conversions a year. This year was hot. The last 2 years, funny enough, off of Y2K, 2020 was a pretty hot year if you think about contract terms. But 125, 150, that's kind of been the high side that I've seen in the last 5 years. So it shows you that big delta, right? Between I'm angry and I'm
And I
actually
got a
getting
theory on
something.
that. I think a lot of banks put the wrong people in charge of doing the core search. And if they're leading it with their, CTO to that effect, all they see is, well, if this conversion screws up, I'm going to blame, I'm going to get fired. If it goes well, I've got to put in so much work and I'm not going to be proportionately, compensated for it. So they'll go through the motions and act like they want to do a core, but also, the fear in their mind, it's greater risk for them doing that conversion than to just stay where it is and band-aid the things. And so, like, what would you say to the owners of the banks, of the board of directors? Who should they put in control of actually coming to the board and giving a
If
thoughtful thesis of why they should or should not switch cores?
I would say
Yeah.
themselves. It sounds crazy, but I think the top-down approach, right? If you really care, I don't know what you could find that's more strategic than a strategic technology decision in this environment. Like, what else are you doing with any time that you have, right? Unless you're just a hands-off owner or a completely hands-off board. So I think and I mean, this isn't a massive amount of time, right? To just get a high-level gut feel for what you're after and what you're looking for. I'm not saying they need to be in the nitty gritty. And something like core, look, I hate it, but you probably want to do an RFP. I despise the RFP process. I mean, what better way to make sure that we replace something we're mad at with something that has the exact same functionality as the
I,
junk that
I
we
hate
have?
the
It's
demo
just insane.
process because you have to sit there through it.
Yeah.
And 90% of it, it's their curated demo. And it's not like you can take control. I would love to just say, here's the sandbox,
Right.
go fucking play in it and let me know. But none of them will go
Yes.
out there and do that. And
Yeah, so I look at it a little different. So actually, Dad coming from the pure analysis on the financial perspective and the Sheshanoff days, I've always used our technology stack data in the same pure analysis concept. So the way that I personally, and this is personal, so let me get weird. The way that I score a vendor, I've got three categories that I look at. So market share is important. I call that 3 out of 5 stars on importance. So I want to make sure that a vendor has market share, right? And namely, so that I can get 3 references, right? So I keep the regulators happy and everything's cool. I want to make sure that I've got roughly 3 peers that I can get references and they're happy. So a vendor with 20 banks live on a product is probably my minimum if it's something strategic, unless I want to go out and collaborate and be a beta, right? So I need some market share, but likewise, somebody with 800 institutions on a product is not necessarily a grand positive because of my next point, which is trajectory. So I want to see the sales trajectory or the churn of that product, right? So I look at it and I give that 5 out of 5 because look, if I had a product that had 800 banks on it, that could be the old stuff that's now in decline, right? And banks are piling out of there. And if I just went off a market share, I would have missed the fact that this is yesterday's news, right? So market share, trajectory, and then the last one I look at is KPIs. So we take the financials of each institution, call report, and then I blend in that tech stack data. So I'll give you a cool example. Take something like account opening, right? Onboarding. And let's look at growth in deposits. DDA is below 250, right? And let's look at that across a vendor's base. Let's say that a vendor has 200 banks installed using this account opening product. Well, let's look at those 200 banks and let's look at growth in deposits compared to a different peer group and see if the damn thing works, right?
Oh
I
yeah.
know it's crazy, but that's what we're doing is trying to look at things in a different way. And so what I typically find when I look through that lens at a bank's problem, now go hire a consultant, pay them 6 figures, take 18 months of RSPs and bullshit, and looking at, I mean, a short list of 20. Are you stoned? There was probably 3 or 4 to ever look at to begin with, right? There's not 20. And I think that the consulting practices have kind of made these things a little more painful than they have to be because, hey, right, you got to sell your service, which I get. But what I often find after going through and comparing the two, we usually do in 30 minutes of time with data, looking at it different and come to the same conclusion or the one that should have been. It's kind of an easier way, I think.
No, I definitely like that approach. Do you find a lot of banks when they're doing their core conversion, they're just checking off a box, or they have no intention of doing conversion? They're just, oh, it's that time. Let's see what's out there, but they just no intention, and they're just wasting their own time.
Yeah, so like I was telling you, there's the 750 that review and 100 that actually switch. Well, think about this, man. We are friggin' killing ourselves in community banking with those numbers because we're making the vendors spend all of that sales and marketing and product budget on wasted demos to all of us. Who do you think ultimately pays for it? It's us, man, right? We go out and waste vendors' time. We're going to have to pay for it. So, I mean, it's something like 5 or 6. Actually, that would be like 7 to get one. That's how a core vendor looks at their pipeline, right? So they need 7 opportunities to win one. Ugh. I think, if you look at some of the other products, let's say online banking, mobile, I'll tell you, man, right now, especially after COVID, 2 of the hottest churning markets are account opening and lending. Any LOS product, especially things like small business, those are churning really hard. Those markets look a lot more like 3 to get one. So we see about 3 times as many reviews for every switch or conversion. So that's a more profitable space, right, for the vendor. Now, granted, whatever their product margins might be, and I mean, hey, there's some big dollars in core, and damn sure cards almost always gets pulled through.
Oh, yeah.
And I mean, what's more expensive than those 2 line items? Hey, I get
How
it.
much involvement
But
do you and FedFis have in regards to fintech sponsorships and with banks? What are you seeing as of that, and what's your future look on them?
dude, that's the spot, man. That's where about 5 years ago, And this is fun. Dad actually really found it. He's always living in the financials. He is by miles and miles the best bank analyst I think anybody's ever seen. I tell him, I'm like, man, there's probably guys that are better than you. They're just dead. You're that old, you know? So I like to give him a little shit on the age and wisdom acquired. But he's looking through the financials, man. And he starts seeing all these really cool banks. And he's like, man, look at these numbers. These guys are making a fortune. What are they doing? And 5, 6 years ago, we started trending together, a number of folks, people like Cross River, people like MBKC, right? And what was, earlier days, half a dozen or more years ago. And then we started digging in because a lot of them were friends, folks like Cross River, right? And we're like, what are y'all up to? And Brian Unruh at MBKC. And it's like, man, I wasn't really listening when you told me the clever shit you were up to, but I'm listening now that I've looked at the profits, And so we got an early view at the coming wave. And so we kind of been ringing the bell for 5+ years. We track all of the BAS sponsor banks and then all of their fintechs. So I'm going to give you rough numbers. I think it's 112 BAS sponsor banks today. And interesting enough, the vast majority of those are very much commercial banks. So seeing the needs with their businesses, if that makes sense. And then the fintechs, it's knocking on the door of 500 that are live and in market. Now, tons more behind, right? And that's starting to include, it's kind of an expanding definition of what I would call brands. So folks like Starbucks, Home Depot, Walmart is a great example. What Walmart is doing, they acquired a fintech called One, and I think they acquired another one as well. But Coastal Community Bank is the sponsor bank sitting behind them. And so Walmart is launching initially basically checking accounts, debit cards, savings accounts for Walmart employees. Well, that's like 1.7 million employees. I mean, that's like 0.5% of Americans. It's a huge friggin' number. And then they'll go after their customer base after that. And so, I think we talk a lot about trust in community banking. Who do I trust more than my employer? Ugh, right? So that one's got my attention as something that's an interesting place where, hey, if businesses started offering banking features, not like we've all thought about it as competitive, but to employees, that's a spot to watch, I think. And if you look at, hey, let's take somebody like Sutton. So Robert Kyle over at Sutton, he's the chairman of our Bass Association board. And north of 100 million cards that run through Sutton from a regular old community bank. Looks like the rest of us, right? There's nothing terribly fancy in terms of technology or size or scope, just some sophisticated people, right, with big ideas. And so here's what's funny. Think back to the old days, and we used to call them issuing banks, the Southwest Airlines credit card, right? You need a sponsor and a custodian sitting behind that. 80% of what we're seeing in BaaS, banking as a service, and with fintechs, 80% is in the card space. Lots of debit, some credit, a whole bunch of prepaid, and folks bending prepaid to do interesting things. Think about what we've run traditionally through ACH rails and how maybe I could use a prepaid card to do that instead and turn a cost into a revenue. Cool. So we're seeing a lot in that area. But I'll tell you, to kind of bring this full circle and put a bow on it, my thought, kind of big future look in here, I think that we're having a tectonic shift in banking from direct to consumer to selling through a channel partner, right? So B to B to C, let's say. So if you looked at somebody like, a Starbucks with all the gift cards that they do, what a wonderful partner to go out and sell products, right? And the customer acquisition cost for the bank is almost free, right? I mean, they're going out and doing the effort for you.
Yeah.
I don't really care if it's my brand.
Deposit interest back to Starbucks's and yeah.
So, hey, I'm cutting them in on a little bit of the, whether it's interchange or otherwise. But hey, I've got basically a third-party reseller out there pushing my services. This is really cool. And I think the question that we all have to answer right now is, is banking as a service an interesting and highly profitable business line that we should explore, or is it a tectonic shift in how banking gets done? And my gut, being so close to a lot of this now for years, my gut is it's a tectonic shift, because I think we're going to see more brands. We've had this whole conversation using examples like Chime and PayPal, right? Or Robinhood or Coinbase. And I mean, Rocket Mortgage. I mean, Cross River sits behind three of those I just named. Wow, it's a fortune. But if you look forward and think about a Home Depot, think about, I call them lifestyle brands, but like I have a Ranger out here at the ranch that I, go fill and I feed with, and I'm always in and out of that Ranger. It's something you kind of personally identify with. Would I get, banking related things from Ranger? I probably would, and especially if I got some rewards, heck yeah. And so, your favorite jeans, your favorite jacket, everything that you really enjoy in your life, I think comes into play as potential distributors of financial services. And my kicker, and I'll stop, those brands don't need to make money on the financial services. That doesn't need to be profitable for them because it makes their business more sticky. It could be a loss leader for them. That's scary because the rest of us need to make money on our financial products.
Yeah. The regulators, I believe, are finally kind of catching up because I've been seeing their institution letters going out and reminding, hey, you got to watch doing sponsorship banks. And because of the successes of the Cross Rivers, the Suttons, and I've been following the Bank Corp for years, you've got some that are doing it right. But then you've got a lot of banks that have had that fear of missing out. And they're giving away the farm, and they truly don't understand what their sponsorship level is. And we're going to see some that are just going to get decimated. And I follow the consent orders and things out there, because that's basically what I feel that Surety is where it's got to be compliance, anti-money laundering first. That's what we know, have to protect ourselves. And so it's, to me, interesting to see coming along. The bank can't defer and say, that's Chime's responsibility to do that marketing. That's, Starbucks. Nope.
It's you.
Because at any point in time, if that fintech screws up or they don't have money, those deposits reside on your core. And if you can't jump in their shoes and service those customers, they'll be definitely hell to pay.
You got it, man. I think this is one of the biggest topics of the day, right? And it's interesting because I think there's a lot of people that have, people have never heard these words before: banking as a service, BaaS, sponsor, right? And maybe that was a couple of years ago, and then that time period has gone into this wave, right? This exuberance around, oh my gosh, and to your point, a lot of banks sprinting to it. The ones that I've seen have trouble, they see it as an opportunity. They get one or two out the door. Maybe they're itty bitty, 500 cards, right? And they say, hey, this was pretty easy. Well, it's never really been battle tested.
Yeah.
Yet they feel like they've succeeded. And then they go and add 50 of them. And it's like, ugh, now you're hanging out there a little bit, right? To your point, our BaaS association, so Out of Bankers Helping Bankers, which has just been incredible, by the way. It's been like the most fun and rewarding thing I've ever done. It's just been great. So I get to do what I like to do, funded by awesome sponsors and by Davey and a number of partners. I get to spend a ton of my time just helping out bankers, right? And cruising around and talking and having fun, which is where I like to play. But under that, we started that BaaS association. And so that board, there's 9 board members, banks on that board. That's a mixture, right? So you've got the Coastals, the Suttons, Evolve, right? A number of those that are just powerhouse names, and a bunch of others that are really up and coming rock stars, folks like Choice Bank, a number of those players. And so it's been cool. There's a lot of different journeys at play and a lot of different philosophies and models. Kind of choose your battles, so to speak. So I've learned a ton getting to watch them all interact. And I don't want to say argue, right? But it's sort of a debate on a lot of these topics because not everything has been battle tested. There's sort of a philosophical of, if X happened, what would a regulator interpret? right? And so you have to kind of play chess a little bit, reading the future of, are we doing this correct? And so I think the collaboration and best practices, uh, let me say it this way: the banks that make an effort to do it correctly, I haven't seen any real trouble, right? It's the folks that are having a ball. There's dollars everywhere. They're hanging out the top of the limo, right? There's been a lot of trouble, with some of those folks. And I'm not calling anybody a bad actor either. I mean, hey, it's the land rush, the gold rush. So it's a lot of fun, but I think you got to watch out. My thing is take it a bite at a time, and I just don't see any trouble from anybody going in eyes wide open.
One last question. I'm curious to see now, are you seeing banks with the adoption of crypto increase or decline since this past year?
I will give you a great one. So I asked this question for friggin' 2 or 3 years now about outflows, right? And so we see just there is so much in these fintechs, right? So think, especially it's exasperated in crypto land. So the Coinbases, the Geminis, et cetera, and all of the fintechs, it's like ACH hop to ACH hop to ACH hop. They're just shuffling, right? And obviously there's fraud everywhere. And so I've been asking banks, just buddies, I'm like, hey man, can you pull me a report and show me outflows to third party fintechs, right? I want to see what's going to a traditional, like an Ameritrade or an E-Trade, right? I want to see what's going to a Coinbase. I want to see what's going to an auto loan at a credit union, right? And so, and I've been bouncing around trying to get a feel for this. My hunch has been, when I heard that 1 in 3 Americans had a Coinbase account or were trading crypto, my hunch was that's got to be high, right? Almost every bank, if you went and look at your ACH out, I bet you there's a bunch of money getting moved to a Coinbase. I was at our roundup a few months, maybe a month ago, and Sunil over at Fiserv gave us a really cool presentation showing at the Fiserv level some of the things that they've looked at, and one of which was showing Coinbase just by a mile was a major, the number one on his list of outflows at one of their institutions. And it just solidified the light bulb for me that how we all feel about it's irrelevant. The users are doing it. Now, I back tested this recently, and 2/3 of the peak outflows or inflows to a Coinbase today, that level is still at 2/3 of what it was, which is shocking, right? You would have thought, hey, I lost lost my ass, right? So I'll stop moving money, and I don't think so. So, and the fact that I think Bitcoin yesterday was back around 16,000. So I mean, it's kind of baffling that it's hanging in there, but I do think, look, the want and the willingness is there from the consumers. I think also, I mean, shoot, we saw Elon and some of those folks. There's some business case too, right? So I've just been baffled at why banks don't participate in a closed loop and something safe with an exchange. And so one that I actually am a big fan of on the board of is Unify Money. It's a traditional wealth management product. You can trade stocks. They've got robo and the basics, but they also have, I don't know, 30 or 40 of the major coins, cryptos that you can trade. And I've looked at it. There's just not very many banks at all that offer crypto trading. And you would think at this point, when it's your biggest outflow, I look back to the early days of P2P, and it's like, are we going to let Venmo win again? This is freaking stupid, right? We're now we've got the big banks with Zelle selling to Fiserv, selling to the rest of us, right? With a P2P situation, and crypto feels the same. It doesn't feel like an option to me, and especially we'll know soon. I think pretty definitively coming out of the crypto winter or crypto Armageddon or whatever the next term is, if it's still around and people are still investing, well, no, it's not a question mark of something, we got to. And I think there's just so much money being transferred. Why let them win?
We still see the
And
volumes in terms.
I'll leave you with one good one. Answer me this question. And find me the answer to this, okay? How much is lost to fraud going out to, let's say, crypto. I would bet you, I'll give you a great example. The old man not long ago, he was just piddling, playing with Coinbase. But I mean, you can imagine he piddled with some pretty big dollars. And the amount of money that got lost and hacked and screwed up that his community bank covered, right? They had to cover the loss. I don't know how much a service would cost with somebody like a Unify Money. I would pick them up and I would offer crypto trading as frickin' defense, not offense, just off of fraud losses. So if you could figure out what are fraud losses due to crypto engagements, that would be a huge thing to answer. That to me is the question. We're talking about what's the opportunity or the offense or the benefit. What is the bank losing in fraud because it's going out to a Coinbase and Coinbase is getting hacked? I bet you just offering a closed loop with somebody that could keep that money safe and not let it get hacked, AKA money transferred out of the institution goes into this and then it has to be transferred back to the institution. Don't allow the third party exchange to transfer money out, and you would X those fraud losses largely because it's just a paper game at that point. Figure out what those fraud losses are, and there's your ROI.
Yeah, no, I like that model. We bank a decent amount of customers that have Bitcoin ATMs. And so that's a little different, so you're taking physical cash to crypto. And so it's got its unique type of customers that we monitor and everything. And as far as the fraud out there that our customers look out for is the elderly abuse, which you're going to find that same thing in, somebody coming to the bank and wiring money out, so they're just using a different form. So we still see that aspect here and there, but it's no more than what you use in money order, here's, an elderly person may have something for sale on eBay or Craigslist and, for $1,000 and they get a check for 2,000. Oh, I'm sorry, I sent you too much. Send me 1,000 back via money order or via crypto. And they do it, so they may use in the crypto rails, but I don't necessarily think it's increased the level of fraud. It just moved it, it just spread it out from money orders or wires to crypto at the same time. Cool.
That's a good observation. I think the key question in crypto for a community bank is whether we're talking about trading paper with an exchange or participating in that way, letting customers. And I think that's largely your retail customers, probably a lot of younger customers. And it's large numbers of customers, but small dollars versus are we actually going to custody crypto, providing an on and off ramp? And my gut is that's more commercial. Yeah. That's, Musk, right? Buying $1 billion worth of something. And you're probably playing with your money movers, your, wealth management, that side of the world. Probably if I was a private bank, I would be interested, right? Family trusts and things like that. But business and wealth, that's where I think the custody side probably plays out versus the exchange for the average Joe.
Being able to offer businesses the opportunity to collect Bitcoin or Ethereum for their sale of product or service and being able to, give them an easy conduit to transfer it into their account. I see a great use case for that.
Right. And it's brought up a weird, I don't know, it's I think it's sort of a cultural shift where you've got a lot of people that have played in that world, and I think they're used to the speed and the exposure, good and bad. Whereas somebody leaves a balance sitting in a checking account or savings account, I can only imagine the waste that I have sitting in all sorts of different things from business to personal. But if you could on-ramp and off-ramp almost real time to something that yielded, frankly, anything with varying levels of risk, that speed to interest or speed in and out of cash, that to me is sort of a light bulb that I think is switched on in a very average person's head, right? You don't have to be a financial analyst or a banker anymore because of the crypto world. They've now had that switch flip that, hey, I can get exposure to something, varying levels of risk in short order and then get back to cash quickly. Yeah. That I think is a fight that we're all going to have to deal with,
Well, good or bad. It's so easy for an average consumer to have 10 different types of accounts because they're still viewing it all through individual apps on their phone. And, they can transfer amongst each other. So, I think the day and age of, having that 5 products or customer are being, sticky is not there anymore. They can have an account on
It's tougher.
Cash App, PayPal, with you. I mean, with whatever bank. So,
You bet.
well, cool.
That's why I think it's important again to look at those ACH inflows and outflows, figure out where things are going, and then as a secondary, maybe a primary, what are my bank's fraud losses on those various third parties? That largely didn't exist in the same manner it does 5 friggin' years ago, right? I mean, I wouldn't have hardly asked the question 5 years ago. Today, it would probably be my first question showing up. I want to know where's everything being moved and what's my fraud exposure in those channels, and think less about, like I said, crypto. I'm not thinking about I want to offer my own Coinbase as an offensive move. I want to offer something safer as a defensive move because I paid friggin' $1 million in fraud losses because Coinbase is a mess,
Oh,
right? My customers keep using
I,
it, right?
I believe
Same with a PayPal or whoever.
I think we'll see where consumers they will pay for a reputable custodian, especially after the FTX debacle and everything. Why wouldn't they? If they believe in the
Right. Well,
blockchain and that's the future, and they pay a few dollars a month to have some level, a higher, greater level of trust that it's going to be there.
you bet. I think so too. And I believe, I mentioned once we get past crypto winter and Armageddon, if things are still around and appear to be steadying out, we'll see. I had a few moments and a few nights there where I felt that things were pretty touch and go. And I think that's stabilizing. But we'll see, to your point, it either impacts the consumer trust heavily, which changes everybody's use case, and or I think it's super likely FTX just ensured some level of regulation, right? And probably something heavy. I think that the crypto world is going to look just like me and you, man. They're going to have to come play in
Well,
our sandbox,
the flip
which
side to it,
that opportunity.
the banks that were holding the deposits of FTX, they did absolutely dog shit of reviewing their AML policies and procedures. I mean, no third party audits or anything. So, I mean, that needs to be looked in pretty hard because I can tell you what, I've had so many crypto related companies that come to us for us to bank. And I've looked at them and, they're at a much larger bank, but they're small. And as soon as we look at their AML policy and that they didn't have third party audits, we wouldn't take them. We wouldn't even touch them with a 10-foot pole. I mean, in FTX, we would have never even opened up an account for them.
Sure. It gets weird. I've dug into a number of these now, and I have felt both ways, which is always fun for
Yeah.
me, right? I reserve the right to tell myself I'm an idiot. And I have felt both ways on this topic now and picked it apart. And I think I've arrived at I'm not sure what I would do to solve the on ramp, off ramp issue. I don't know that there's a perfect answer, or at least one that's been battle tested. But if you look at, there becomes this question mark of time value because everything isn't real time, right? And we live in a very batch world. I think, thankfully, um, where did something reside at what moment in time with a crypto on ramp and off ramp? That brings all sorts of things into question. And then you start thinking about things like FBO accounts, who owns the account.
Mm-hmm.
It gets messy. It's really messy. And so I think we're seeing some tests of all those. And I'll tell you, I mean, between Voyager, FTX, others, we've seen what has become kind of an interesting use case, which is we've got let's say a bankruptcy situation. Everybody just says freeze, right? Let's review this, locking up deposits for X period of time until we can actually vet everything out, which actually tells me that while that's a really scary, nasty headline, right? That actually tells me that things are working because if we're able to reconcile our way through that, however long and painful it may be, then that means that it was
Yeah.
reconcilable. To me, the question has always been, and I think as we've seen with some other, situations, fintechs, and with some other sponsors, things that obviously were not reconcilable. And until it was tested, nobody knew that, right? So I think that's kind of an underpin, right? Can you unwind this friggin' thing? No matter, I mean, hey, it might be hellacious to pull off, but can you reconcile everything given enough time to look at it? And if the answer is yes, then you're at least in words that should approach safety and
Yeah,
soundness.
absolutely. Well, Tanner, I mean, thank you for your time. I don't want to take any more. If you could let my viewers know, where can they find you?
FinTech Cowboys is a great place just as a resource. You're going to be on with us here soon, man. So I'm going to
Cool.
get to pepper your ass with some questions next. But fintechcowboys.com, there's tons and tons of episodes and things on there. We just go around and have these kind of chats with cool people like yourself. And then fedfiz.com, that's the data company, man. That's where we do all the cool industry insight
Man, well,
stuff.
I'm so glad there's people out there like you in the bank community because, I mean, I've been in banking 21 years and the bankers are just, to me, such nice, trustworthy people. And then there's so many, they fall prey to, marketers and all these fake terms where it's just, I'm getting sick of let's reframe this or let's, think like this. And, I just feel that they're being taken advantage of out there because there's not the answer. Most of the new shiny stuff, it's old. It's just repainted in a different way. And if the banks just
You got it, man.
stopped and look at their own and maybe got rid of half of their services that they're already under contract with, they don't really need, they could be profitable. Because when I started in banking in '01, we had over 300 banks headquartered in Florida. Now we're under 100. And and then I'd always hear, oh well, you can't have an economies of scale to your 500 million in assets, now a billion in assets. That's bullshit. We're 200 million and we're profitable, and we've been profitable for years and we'll continue to be
At,
profitable.
at 8 billion in assets, am I going to compete with JP? Of course not. It just doesn't work, man. Scale merging for scale is like it's asinine. That doesn't get us there, you know.
No.
But I'm with you. I think the misinformation, I call it the dipshittery that's out there. It's all so much that is just designed to sell products and shiny things. And we have lost the best part of community banking, which was trust. We all used to tell each other the damn truth and everybody used to be accountable and everybody worked together like literally for generations, man. I mean, I was the little kid running around banking conferences that were just filled with bankers, and now you go somewhere with 30 bankers and it's like, wow, what a great event. We're getting our asses kicked. And I think we need to get back to investing in each other and trust and back to networking together and relying on ourselves. But I think community banking as a community has to choose life, man.
Yeah.
We have to decide we want to be saved and save ourselves, and to not look the shiny technologists. I mean, hey, that's where I spent a large part of my time and career as well. It's not there. It's a really nice marketing story and a big marketing budget.
Awesome. Man, Tanner, it's great to have you.